Hey guys, what is up? Welcome back to my channel. In today's video, I'll be talking about Victor Sperandeo's 1-2-3 method and his 2B rule. Before we take a look at Victor Sperandeo or Trader Vic, we'll first take a look at who Victor Sperandeo is. Victor Sperandeo is a US trader who traded on behalf of other notable investors such as George Soros. And Victor Sperandeo managed to predict the 1987 stock market crash and shorted the Dow and made 300% during a day that the Dow Jones Industrial Average fell by 20%. In fact, I have a video over here talking about the 5 lessons that I learned from Victor Sperandeo's book, Principles of Professional Speculation. But in today's video, because I received questions about Victor Sperandeo's 1-2-3 method and his 2B rule, I decided to create this video just talking about the 1-2-3 method and his 2B rule. Alright, so if you are interested in Victor Sperandeo's 1-2-3 method and his 2B rule, make sure you stick around in this video. So Victor Sperandeo's 1-2-3 method is to help him identify the change of trend. Because as investors and traders in the stock market, we all know the importance of being able to identify the change of trend. If we are able to accurately identify the change of trend, for example from an uptrend to a downtrend or from a downtrend to a uptrend, we will be better able to make our investing and trading decisions in the stock market. Furthermore, by being able to accurately identify the change of trends in the markets, we are able to limit the downside to our portfolio. For the 1-2-3 method, there are 3 criteria to be met. And if all 3 criteria are met, this is the equivalent to a Dow theory confirmation of a change of trend. And why is the Dow theory confirmation of a change of trend important? This is because for the Dow theory, it has been one of the most accurate way in identifying the change of trend. If the 3 criteria are met in Victor Sperandeo's 1-2-3 method, this is equivalent to the Dow theory confirmation of a change of trend, which can help us identify the change of trend with a very high probability of success. The first criteria to be met in the 1-2-3 method is that the trend line must be broken, and the second is that prices must stop making higher highs in an uptrend or lower lows in a downtrend. And finally, for the third criteria, prices must go above a previous short-term minor rally high in a downtrend or below a previous short-term minor sell-off low in an uptrend. If all of this seem a bit confusing for you right now, don't worry, because I'll be going through the individual criteria with you in greater detail. The first criteria in Victor Sperandeo's 1-2-3 method is that the trend line must be broken. And there are 2 different ways for the trend line to be broken in the market. One is for an uptrend, and the second one is for a downtrend. So we'll take a look at an uptrend first. The uptrend line is drawn to connect the lows for prices in an uptrend. This is the uptrend line which connects the lows of prices. At this candlestick over here, we see that prices broke below the trend line. So at this point over here, the uptrend line was broken. And that is how we identify the first criteria of the 1-2-3 method in an uptrend. For a downtrend, this is how a trend line looks like. The trend line is drawn across to connect the highs of prices in a downtrend. So over here, we have this downtrend line, and this downtrend line is drawn to connect the highs of prices. And we see for this candlestick over here, this candlestick broke above the trend line. For this point over here, the downtrend line is broken. If prices are on a downtrend and prices break above the downtrend line, this is the first criteria to identify a potential change of trend. That's the first criteria in the 1-2-3 method in identifying a change of trend, that the trend line must be broken. So for an uptrend, prices must break below the trend line. And for a downtrend, prices must break above the trend line. The second criteria in Victor Sperandeo's 1-2-3 method is that prices must stop making higher highs in an uptrend or lower lows in a downtrend. In an uptrend, prices must fear to make a new high point or barely breaks the high and then fear. For this example over here, on the left side of the chart, prices for JP Morgan is on an uptrend. We know prices are on an uptrend because prices are making higher lows. So this is at one low, another low here, another low here, and another low here. So prices are making higher lows. Prices are also making higher highs. So this was one high, another high over here, another high over here, and another high over here. When prices are making higher lows and higher highs, we say that prices are on an uptrend. But over here, can you see that prices fear to make a higher high? Because if we were to compare to the previous high, which is over here, prices over here did not manage to make a high that is higher than this high over here. At this point over here, prices stop making higher highs. And that is the second criteria in Victor Sperandeo's 1-2-3 method in identifying the change of trend. In a downtrend, we want to see prices fear to make a new low point or barely breaks the low and then fear. Let's take a look at what this means. From this part of the chart to this part of the chart over here, we see that prices are on a downtrend. And we want to see for these 2 confirmation points for a downtrend, that prices are making lower highs and lower lows. If we were to compare the highs, this high is lower than this high is lower than this high, and this high is lower than this high, and this high is lower than this high, and this high is lower than this high. So prices are making lower highs. The next thing that we want to pay attention to is the lows. So this is one low, and this low is lower than this 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 low. So from the left side of the chart to the right side of the chart, we see prices making lower highs and lower lows. And when prices are making both lower highs and lower lows, we say that prices are on a downtrend. At this point over here, prices stop making lower lows. When prices stop making lower lows in a downtrend, this fulfills the second criteria for Victor Sperandio's 1, 2, 3 method for a downtrend. The third criteria in Victor Sperandio's 1, 2, 3 method is that prices must go below a parallel low in an uptrend or above a parallel high in a downtrend. When prices are in an uptrend, for the third criteria to be filled, we want to see prices go below a previous low point. This is an example that we have used earlier on. Earlier on, we saw that this was the point that prices failed to make higher highs because the previous high was here, and over here, prices did not make a higher high compared to this high. For the third criteria, we are taking a look at the parallel low. So the parallel low was over at this point over here. So we draw a line across and we see that over at this candlestick over here, prices fell below the parallel low. And this is the point that prices go below the previous low. And when prices go below a previous low in an uptrend, this fulfills the third criteria in Victor Sperandio's 1, 2, 3 method. In a downtrend, for the third criteria to be met to identify a change of trend, we want to see prices go above a previous high point. As we have seen earlier on, this area in the price chart indicates a downtrend, and this is the previous high. At this point, we draw a line across, and we see that for this candlestick over here, this is the candlestick that prices close above the previous high. This is the point that prices go above the previous high, and also the point which fulfills the third criteria in the 1, 2, 3 method. To recap, these are the three criteria in Victor Sperandio's 1, 2, 3 method. The first is that the trend line must be broken. For an uptrend, we want to see prices breaking below the trend line, and for a downtrend, we want to see prices breaking above the trend line. For the second criteria, we want to see prices stop making higher highs in an uptrend or lower lows in a downtrend. And finally, for the third criteria, prices must go above the previous short-term minor rally high in a downtrend or below a previous short-term minor sell-off low in an uptrend. So those are the three criteria in Victor Sperandio's 1, 2, 3 method. Now, we'll take a look at Victor Sperandio's 2B rule. Victor Sperandio's 2B rule is a variation of criteria 2 in the 1, 2, 3 method. To jog your memory, the second criteria in the 1, 2, 3 method is that prices must stop making higher highs in an uptrend or lower lows in a downtrend. The 2B rule is a variation of the 1, 2, 3 method. Because in the 2B rule, Victor Sperandio weighed criteria 2 the most. And because Victor Sperandio weighed criteria 2 the most, many times when prices meet criteria 2 in the 1, 2, 3 method, or the 2B rule in this case, it signals to him a high probability of a change in trend. And Victor Sperandio might act on this 2B rule instead of waiting for all three criteria to be met in the 1, 2, 3 method. So in this way, the 2B rule is a slight variation of the 1, 2, 3 method. For this example, we see how Victor Sperandio implemented his 2B rule for prices in an uptrend. At this candlestick over here and at this point over here, prices failed to make newer highs. And because prices failed to make newer highs, Victor Sperandio implemented his 2B rule in this case. And you can see that immediately after that, for this candlestick over here, Victor Sperandio sold his share over here. He did not wait for prices to break the uptrend line or for prices to go below the previous low, which is the first and third criteria respectively in the 1, 2, 3 method. And this is how Victor Sperandio implements his 2B rule in the stock market sometimes. Sometimes he doesn't wait for all three criteria to be met in his 1, 2, 3 method. For a downtrend, we see that for this candlestick over here, prices failed to make newer lows. And if Victor Sperandio implemented his 2B rule, he would have gotten out of his position at this candlestick over here. Rather than waiting for prices to break above the trend line or for prices to go above the previous high, which is the first and third criteria respectively in Victor Sperandio's 1, 2, 3 method, he just makes sure that the second criteria is met and went ahead with his decision. And that is what the 2B rule is about. So to recap, Victor Sperandio's 2B rule is a variation of his 1, 2, 3 method. The difference between the 2B rule and the 1, 2, 3 method is that for the 1, 2, 3 method, we want to see all three criteria to be met. But for the 2B rule, because Victor Sperandio weighed criteria 2 the most, sometimes he doesn't wait for the first and third criteria to be met. He just follows the second criteria, and that is his 2B rule. What is your main takeaway in this video? Let me know down in the comments below. If you have learned something from this video, smash the like button because it will really help the algorithm push out my video to more people. And if you are new to this channel and haven't already subscribed, make sure you subscribe to this channel because each week I release new videos about investing, trading, and the stock market. And if you have liked this video, make sure you watch my other videos. I'll see you in those other videos. To your financial success.